While gyration was seen in the US stock market yesterday, as we registered mixed performance, despite the fact that the CPI data came in lower than expected. The main culprit will be the resurgence of oil prices that rallied by 5% yesterday, where the West Texas crude oil closed at around $95 per barrel, rallying from our short-term pivotal support at around 76, despite the fact that the IEA recorded or came into the conclusion of a unprecedented historical oil stockpile release. The US-Iran war continues to extend to its 13th day, showing no signs of escalation, and worse still, Iran now has started to attack any ships that try to sail past the Strait of Hormuz, creating a lot of tension between stakeholders and as well as leading to a firmer US dollar as the short-term dynamics has started to get clouded in this ongoing Iran-US conflict. Very good morning to all and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here. Today will be the Thursday, the 12th of March 2026. So before we dive straight into today's gist of the Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. Okay, so here we go. Okay, hope that the screen is good. All right, so let's start what has taken shape yesterday in terms of the news flow and as well as relevant economic data release. So start with the news flow. That is much more very important, as this is the main driver that's causing the volatile movement in the broad-based cross asset classes on the intraday basis. So before I touch on the individual FX market, the broad-based broad-based global indices, let's take a quick recap what has taken shape yesterday in terms of the news flow surrounding the US-Iran war over here. So despite the fact that we know that the International Energy Agency, where at the start of this week, there's this rumbling stating that there will be a coordinated stockpile release over here that created a relief rally in the global stock indices and also saw oil prices plunging from $119 per barrel on the West Texas crude oil to as low as around $71/$72 per barrel. So yesterday, it was kind of confirmed that there will be a coordinated release of 400 million barrels, a total drawdown. So that is the historical unprecedented release of stockpile in terms of, we call it negating this ongoing firmer rising oil prices, and it's also significantly higher than the volume that followed during Russia invasion of Ukraine in 2022. And US, because this is coordinated among the G7 nations, so US will announce on its side to release 172 million barrels as part of this coordinated effort to cool prices. But despite this news flow, oil prices didn't back down, but instead oil prices continues to rally, where Brent crude jumped as much as 8.2% to 99.54. In fact, it's about $100 per barrel now as we're speaking again. And the West Texas crude oil from the US side, the WTI crude, jumped to around $95 to $96 as we are speaking right now at 11:12 a.m. Singapore time. So the reason why we call it this oil price didn't back down is due to the Iran defiance, stating that they will keep on attacking tankers as it continues to flow past the Strait of Hormuz, and even tankers that is surrounding key stakeholder in the Middle East. So oil tanker, even though they didn't go past the Strait of Hormuz, they just park on any harbor front in the Middle Eastern stakeholders like Iran or Saudi Arabia. They got hit as well by Iranian attack. So that actually created a positive feedback loop into oil prices, despite the fact that there could be much more, we call it, putting away that this, what I call it, a geopolitical risk premium has overshadowed this potential IEA coordinated historical stockpile release, given the fact that as long as this Iran-US war keep on continuing from both sides, there's both sides attacking one another, oil prices faces a higher probability of more disruption, which in turn IEA stockpile release may not be able to cool down these firmer oil prices. So we know that once oil prices rallied, it created stagflation fear. Stagflation fear created a fear of liquidity squeeze because the Fed, which is the US Federal Reserve, may find their hands tied or face a obstacles to continue its interest rate cut cycle this year. All right, so let's take a look at the CME Fed Watch 2, right, that show the probability on the Fed funds futures markets in terms of percentage odds whether the Fed will hike, cut, or hold in the coming months ahead. So if we were to look at the current one, which is next month, pardon me, next week, 18th of March, market is looking at almost 100% chance that the Fed will stamp at 98.3% over here, all right, because the current Fed funds rate is 3.5% to 3.75%. So let's look at the aggregated tab over here. So this aggregated tab will tell us what are the probability in terms of whether the Fed will be holding, cutting, or pausing its interest rate in the months ahead. So we know that previously market is looking at the summer months, either June or July, to ignite its next interest rate cut. So that will be the fourth cut in this ongoing interest rate cut cycle, but that probability has started to dwindle down significantly in the last 2 weeks. So right now, market is not looking at even any slight chance of a cut in June. So that has been greatly reduced to 38% over here. So market is expecting 62% stamp pad. Then if you look at the next month, which is the next summer month, which is July, 29th of July. So this is also now become a coin flip of 57%. So previously that was about 60% to 70% chance. So now it's deep down to below 60%. So almost a coin flip that market participants is expecting. I would say that even a 57% chance is very low. The Fed may continues to stamp at in 29th of July 2026 meeting as well. So the next probability now has a higher chance is either to come in the Q3 of this year, that means during the autumn of 2026, either on the 16th of September, which has a high chance of 80% to bring it down to 25 basis point, or 28th of October, 96%. So, but what's interesting over here is that the initial pencil in 2 interest rate cut at the minimum has now only been reduced to 1 interest rate cut. So how do we see that? By the last meeting of the year, which is of this year, 9th of December 2026, market is now have a high chance of 90% that the Fed will have its Fed funds rate at 3.25% to 3.5%. So taking into account of the current Fed funds rate, current Fed funds rate at 3.5% to 3.75%, that only implied 1 interest rate cut for this year. So that has been reduced from the earlier expectation of 2 due to this ongoing stagflation risk that is still intact based on yesterday's price movement in the oil market, due to the current context that what is playing out in this Middle East region due to this ongoing Iran-US war that is showing no signs of backing down or de-escalation. So with stagflation fears rising, with the Fed unreluctant potentially to cut rates as earlier expected by the market participants at the start of this year, where they look for 2 interest rate cut, now has been reduced to 1. And if oil prices continue to go up to beyond 120 per barrel, in fact, there could be a risk that the Fed may not cut rates at all this year. So that could create a liquidity squeeze into the financial market. So that actually explained to us the Test 1 2 3. Mic test 1 2 3. All right, pardon me, I think there's some technical issue this morning that causes the sound of the mic to actually be rather jittery, almost very similar to the market as well. Very volatile. Sometimes it get on, sometimes get off. So hopefully things get better now. So where was I earlier on? Yeah, talking about the underperformance of the US financial stocks, especially some of the Dow Jones heavy weighted component stocks, which is the top three. One of them is Goldman Sachs, which is down by negative 1.21% yesterday. So let me go back in time. All right, over here, Goldman down by negative 1.21%. So the reason over here is due to private credit woes over here. So private credit, this particular segment within the US financial industry, in the last 1-2 years, they were very hot, receiving a lot of money inflows, given the fact that private credit is one of the segment that outperformed the general market. But because of the start of this year, there was actually this AI disruption play that could reduce the profit margin of SaaS company. That means software as a services firm, which is the likes of Microsoft would be one of them. Then we have other like Workday is one of them as well, and that could see private credit within this industry, which is SaaS company, got hit as well as their profit margin get cramped down due to AI disruption, which in turn could see more bad debts souring in this private credit segment. So that led to a negative feedback loop in the US financials stock yesterday. And yesterday also, JP Morgan, one of the major US financial we call it giant, restricts private credit lending after the recent markdown. So that create a further reinforcement of this negative feedback loop in the US financial stocks yesterday. So that explained to us why the underperformance of the US financial stock yesterday, which in turn lead to an underperformance of the US Dow Jones Industrial, because the US Dow Jones Industrial has a higher weightage towards the financial sector. All right, and now onwards towards the FX market. So we know that in the FX market, with this firming up of oil prices, that create a rally in the US we call it the US dollar, almost across the board, except for the commodities currency that has lesser impact over here. So if you look at the 5-day rolling performance of the dollar against other major currency, with the Euro Swiss, as of now we are speaking, the dollar didn't rally much against the Aussie. In fact, the dollar is down against the Aussie by negative 1.7%, based on the 5-day rolling performance. And also the dollar is down against the Canada dollar, the CAD negative 0.62%, because the CAD and the Aussie are linked to commodity prices. So we know that if oil prices rises further, it could create a positive feedback loop in all the other commodities prices as well, given that most of the time, like for example, with food price, fertilizer is all related to oil prices over here. But however, economies that are very sensitive negatively to oil price, like the Eurozone over here, which is a kind of a key net gas importer, followed by Japan, also a key net oil importer, or they are pretty much dependent on energy to run their economy. Their respective currency is performing the worst against in the FX market, where the dollar rose against the yen close to 1% yesterday, and the dollar rose against the euro with a 5-day rolling performance at 0.63%. So if you look at the 1-day rolling performance in the last 24 hours over here, similar movement as well. What you could see is that the CAD is actually almost unchanged. The dollar CAD is almost unchanged. All right, over here. So what we could see at this point in time is that despite the fact that we start to see a weaker print of the core CPI data for February, but that is in the past over here. So let me share with you guys yesterday. There was this release of this core CPI inflation rate. So the core CPI inflation rate, as well as the headline inflation rate over here For the core inflation rate year on year, it came within expectation at 2.5%, whereas the inflation rate year on year also within expectation. But if you look at the where is it? The Give me a minute. Yeah, so all of them came in within expectation. The core year on year at 2.5%, the headline inflation also at 2.4%, but that is in the past for the month of February. So market now is looking forward that if oil prices continues to rise and remains firm and we're still hitting above 120 per barrel, if this conflict between US, Iran, and the Middle Eastern stakeholder didn't de-escalate, future inflation trend in the US may continues to go up over here. So that actually explain why the dollar didn't fall. Instead, in general, the dollar actually rose against those countries, especially that are net importer of energy resources. All right. And with that being in picture in mind, that also created a negative feedback loop in the Asia Pacific stock market as well. So if you look at the Asia Pacific stock market today, all of them are in the red. The Nikkei 225 is down by negative 1.54%, trading near the session low. And the Nikkei 225 futures, taking into account of yesterday's US price action, is down by negative 1.6%, also trading near the session low. The Hang Seng indices totally erase yesterday's and Tuesday's gain, down negative 1.3%. And if you look at the China A shares market, the CSI 300 also down by negative 0.7%, trading at the session low, followed by the narrower China A50, also down by negative 0.6%, trading at the session low as well. And if you go across the other Asia Pacific benchmark stock indices, all of them are in the red. The ASX 200 down by negative 1.6%, trading near the session low. Kospi 200 down by negative 1.41%. Over here, trading near the session low, and as well as our defensive Straits Times Index also down by negative 0.8%, trading very close to the current session low as well. So what we could see over here is that the main, we call it the main, what I call it, trigger that could create this ripple effect across the market is oil price. All right, so if oil price continues to go up firmer, we see a negative feedback loop in the broad-based benchmark stock indices. That means the benchmark stock indices cannot rally that much, and some of them starts to go in a very messy sideways range. And also a firmer US dollar with asset towards the commodity-based currency like Canada dollar and the Aussie dollar, and in some form the Kiwi dollar, given the fact that because the Aussie and Kiwi has a direct correlation. And later I'll share about gold. So gold price continues to hold firm above the 20-day moving average around the 5,046 level, 5,046 level. But however, gold price can't rally much further as well because it's being stuck by opportunity costs. So if the Fed doesn't starts to cut rate this year, interest rate will not come down. And if interest rate doesn't come down, gold itself being a non-income bearing asset will has higher opportunity cost. So there's these two conflicting factor that is impacting gold prices right now. That actually explains why gold price can't rally as a hedge due to the fact that it's being caused by rising oil prices. Rising oil prices potentially lead to a higher interest rate environment. All right, going forward. All right. So that comes the first segment of the daily dose over here. So now let me touch on the second segment. Yeah, before I jump into the second segment over here, is that there's this particular new flow is that Iran continues to remain defiant, and it tells the rest of the world to get ready on oil price hovering at $200 per barrel. So what Iran wants now over here is that they refuse to allow any ships to pass in the Strait of Hormuz, and even launching attack for other oil tankers that is parked at the harbor of Saudi Arabia, Iraq, which is those oil producing country. therefore having a very staunch, we call it approach in disrupting oil supply, hoping using higher oil prices to counter the attack coming up from US and Israel over here. So it doesn't seem to be backing down from both sides. So that could potentially lead to a firmer oil price going forward. All right, so that is the key, we call it linking the dots, and as well as linking the current fundamentals with news flow of what is playing out in the market right now. Right, so with that, let me go to the intraday technical outlook on the various broad-based cross-asset segment. So with that, let me expand my screen. Right, so hopefully the screen is good over here. Okay, so let me touch on the FX market first. All right, so before I touch on the FX market, the individual pair, let me very quickly take you through the dollar index. All right, so the dollar index continues to bounce from this support level at 98.55, which was slightly above the 200-day moving average, and the pullback line of this former descending channel now turns into a critical near-term pullback support that previously was resistance from 24th of November last year and 16th of January this year. So right now, the US dollar index is now attempting to retest last week high during the onset of the US-Iran war broke out at 99.68. Breaking above 99.68 may visit the critical medium-term range resistance level of 100.10 and 100.54 over here, which is this complex range resistance that has been in play since the high of 29th of May last year. So that's close to about what 11 months, close to about 10 months of range resistance or so. So with that, there could be some form of push up if 99.68 is taken out for the US dollar index to see further potential upside towards 100.10 and 100.54. Right, so that's the US dollar index over here. So bear in mind that if the US dollar index is still relatively strong right now, there could be a risk of the euro dollar revisiting the 9th of May, which is this Monday swing low area. So with that, after yesterday's price action of tumbling down below our lower limit of that neutrality zone that we highlighted yesterday at what 155.50. So with that, I'll be using 116.05 as my short-term pivotal resistance for today. Have a intraday bearish bias view to revisit 114.95, 114.70 on the euro dollar. Right. However, if price action is able to recapture back above 116.05, then potentially we may see a prop at the 200-day moving average again, which is acting as a next intermediate resistance level at 116.73 on the euro dollar. So using a rather tight short-term pivotal resistance yesterday, which is yesterday's bearish reaction level after the release of the core CPI data at 116.05, potentially revisiting this Monday swing low area at 114.95, 114.70, using 116.05 as the short-term pivotal resistance. Next up will be the sterling pound over here against the dollar. So the sterling pound now is testing our short-term pivotal support level that we have yesterday at 133.70. So yesterday we do have a bullish bias during the release of the core US CPI data / inflation data. It did almost hit our first resistance level at 134.50, printed intraday session high at 134.23, okay, before trading downwards over here. So with such lackluster movement of the price action, and with the daily, the hourly RSI breaking below its ascending trendline support level, there could be a potential risk of the sterling pound to revisit this Monday low again over here. All right, it's a range that confluence with the swing low of last Tuesday as well, the previous Tuesday or last Tuesday, 3rd of March. So with that, I will have a bearish bias view on the intraday basis on the sterling dollar, given the bearish breakdown of the hourly RSI, using 134.50 as my short-term pivotal resistance level, which is very close to yesterday's US session intraday high after the release of the core US CPI data, and so confluence with the 200-day moving average and the 20, and as well as the medium-term descending channel resistance that has been in play since the high of 28th of January this year. So using 134.50 short-term pivotal resistance level, breaking down below 133.70, 133.70, potentially may revisit 132.83/132.85. Okay, let me put it in writing. 132.83/32.65. Only a bullish breakout and a reversal back above 134.50 and an hourly close above 134.50 that would invalidate today's intraday bearish bias view to see a squeeze up to revisit the 50-day moving average, I think, as the next intermediate resistance zone over here, which is the also the congestion area of 25th of February and 27th of February at 135.05, 135.23. So that's for the sterling dollar. Next will be the Aussie dollar over here. Okay, so the Aussie dollar continues to hold rather firm. Okay, still trading above our Titan short-term pivotal support level at 70.80 over here. So using 70.80 as my short-term pivotal support level, we will still maintain a mild bullish bias for it to revisit 71.70. Breaking above 71.70 will start to see a better bullish momentum traction gaining play to revisit the 4th May/2nd June 2022 swing high at 72.46, 72.66. So 72.46 is also the 2 times pivot extension of this ongoing recovery from the low of 3rd of March. However, breaking down below 70.80 will invalidate this bullish bias view towards 71.70 and see it floating down towards 70.50, 70.30, which is the pullback line of this former minor descending channel resistance in dotted green from the high of 27th of February, now turns into a pullback support at around 70.50, 70.30. And if you do the Fibonacci retracement of this recovery from 9th of March all the way up to yesterday's US session high, which was the onset of the exposed US CPI data release. That's also confluence with the golden ratio of 61.8% over here. Only breaking below 70.30 will see a deeper minor corrective decline to revisit the 50-day moving average and also retesting the 3rd of May key minor swing low level at 0.6944. Okay, so that will be the Aussie dollar. Now, next up will be the dollar yen. So the dollar yen squeezed up yesterday back towards the 159.45 level again. So this 159.45 level is where previously there was this rate check that is being done by Bank of Japan, and this coordinated check also done by the US Treasury in the FX market that created the risk of joint FX intervention. So why they did the check at that point in time was due to this loop that Japan snapped election previously, right, to prevent the dollar yen from spiking up higher towards the 161.95 level. So that's our long-term pivotal resistance, which has been formed on 3rd of July 2024. Previously also attracted FX intervention at that point in time. So far there are being recorded 2 FX intervention, previously at the 160.23 at 26th of April. And this point in time over here, there was also potentially some form of FX intervention, but that was not being made public. The one that's made public will be on 12th of July 2024 over here. This level here, 12th of July 2024. Let me share with you guys. Yeah, so 12th July 2024, the high of that particular day was at 159.45. Okay, 159.45, which is exactly at the high that was seen on 14th of January this year. All right, where we start to see the fear of a FX intervention taking shape yesterday as well, where both sides only admitted that there are rate checks that's being done on the FX market by both sides of the offs from Japan, Ministry of Finance and the US Treasury Department, all right, at the point in time. So with that, bear in mind over here is that the market participants will also be quite worrying as you're now approaching this 159.45 level, given the fact that previously it induced that intraday sell-off at the end of at the end of January, which I show you on the daily chart. So with that, I will have a neutrality stance today on the dollar yen. So neutral between the intervention level at 159.45, which has been undertaken previously, 159.45, 159.45. Lower limit will be at the 158 figure level. This minor congestion area of 11 of March and 11th of March at 2 p.m. Singapore time yesterday, and also confluence with the lower limit of this minor ascending channel that I drew from the low of 17th of February, connecting to the lower toward the low of 10th of March and 11th of March at 158 figure. So neutral between 159.45 and 158 figure. And also the hourly RSI has shaped a bearish divergence of a lower height over here. So watching very closely these two levels, 159.45 and 158 figure level. All right, so only breaking below 158 figure level may introduce further minor weakness to revisit 157.40, below it 156.45, 156.17. However, if price action don't stop at 159.45, then potentially we may see a squeeze up towards higher level, 160.23, 160.74, and the key long-term pivotal resistance at 171.70, 171.95 over here. Okay, so that's for the dollar yen. Okay, now let us now touch on the major stock indices, starting with the Hong Kong 33. All right, so the Hong Kong 33 erased off the gain that was being seen on Tuesday as well. Okay, now trading back below the 200-day moving average, but still holding above our short-term pivotal support that we have yesterday. So given that if oil prices didn't come back down, there could be a risk that the Hong Kong 33 may drift down lower. So with that, even though it's going to hold above our short-term pivotal support level that we have yesterday, I will not have a bullish buyer stance for today, given the fact that it has a negative correlation with higher oil prices. So neutral for now between 26,147, which was Tuesday US session high, and also the lower limit of this medium term, the upper limit of this medium term descending channel from the that is still in play from the high of 29th of January 2026. So neutral between 26,147 and 25,385. However, if we see a breakdown below 25,385, then we will revisit the current long-term pivotal support at 24,765, which is almost hit during Monday's intraday low at 24,822. Okay, so that's for the Hong Kong 33. Next will be the Japan 225. So the Japan 225 representing the Nikkei 225 also continues to hold above our pivotal short-term pivotal support zone that we have yesterday at 53,616, 53,066. So with that, given the fact that it also has a negative correlation with higher oil prices, we will flip to a neutrality stance for now for today. So neutral between 53,616, 53,066, and 55,760, which was yesterday's Asia session high. All right, at 55,760. So unless price action could go back up above 55,760, then potentially we may see a further push up towards 55,626 in first step, which is the 20-day moving average. Above it, seek out 57,774. If price action plummet below 53,066, then we will revisit this Monday's swing low again at 51,055. All right, so that's for the Japan 225 over here. Next will be the Germany 30 over here. So the Germany 30 continues to plummet lower over here and breaking below our pivotal support level that we have yesterday, a very tight one at 23,455. So now there could be a risk that it will revisit this support level at 22,220, 23,220, 23,068. So this level, if we do the Fibo retracement, that is the 61.8% and the 76.4%. And given the fact that it has a bearish reaction right exactly at the 200-day moving average on Tuesday US session, then thereafter it tumbled lower over here. And given that the fact, if you look at the hourly RSI, okay, it continues to trade downwards. Come on. Okay, it's now testing this key parallel ascending trendline support level over here. All right, so with that, I will have a rather tight short-term pivotal resistance level. Let me do an adjustment, everything. Okay, over here, which was also yesterday's, today's Asia session high as well, 23,516. Okay, let me tidy up everything. 3,834. Okay, so using this former minor swing low broken down during today's Asia session at 23,516 on the Germany 30, representing German DAX. So rather have a rather tight short-term pivotal resistance level for a bearish buyer's view to retest this 23,220, 23,068, which is the 61.8% and 76.4% Fibo retracement of that previous recovery from Monday low all the way up to Tuesday US session high. So with that, flip to a bearish bias, breaking below 23,068 may offer further weakness to revisit this Monday swing low at 23,687. Pardon me, at 22,687. Only a bullish breakout above 23,516 will invalidate the bearish bias view intraday to see a squeeze up towards 23,834. Above it, revisit the 200-day moving average, again being resisted at 24,162 next over here. So that's for the Germany 30. Next will be the US Wall Street 30. So the US Wall Street 30 broke below our short-term pivotal support level at around this 47,000 range over here, 47,000 level, and now is potentially enrolling back again to revisit the 200-day moving average, which is also our long-term pivotal support level that we have on Monday, 46,330. So with that, flip to a neutrality stance for now for the US Wall Street 30 between 46,330 and 47,460, which was yesterday bearish reaction seen during 3 a.m. Singapore time today. Only a bullish breakout above 47,460 will negate today's bearish tone, or bearish tone to be in this sideways range to see a recovery back to retest this Tuesday US session minor swing high area at 48,119, which is also the pullback line of this former medium-term ascending channel support from the low of 23rd of May 2023, 23rd of May 2025. But if we start to see a breakdown below 46,330, then the longer-term trend of the US Wall Street 30 will be the damage, and we may kickstart a multi-week / multi-month movement on the US Wall Street 30, exposing the next near-term support in first step, 45,780, 45,485, 45,237, 45,191, which is, if you go back over here, the swing low area of 15th of October last year, 17th of October last year, and 10th of October last year. All right, so that's for the US Wall Street 30. Next will be the SPX. So the SPX yesterday also dipped down. It didn't break below our short-term pivotal support at 6,677. So with this lackluster movement and higher oil prices, that has a negative feedback loop on the US stock market as well. We will have a neutrality stance today. So neutral between 6,775, which was the high that was being seen during yesterday's US session. In the middle part of the US session, 6,775. And we were neutral between 6,775 and 6,677. Only a break up back above 6,775 may revisit the 20-day moving average, I think, as the next intermediate resistance, which was this Tuesday US session high at 6,848. All right. So breaking down below 6,677 will revisit the 200-day moving average, and as well as this Monday key swing low area at 6,610, 6,585. Very similar on the Nasdaq 100 as well. So the Nasdaq 100 also managed to still hold above our short-term pivotal support that we have yesterday at 24,550. But given the given its indirect correlation with higher oil prices, we will flip to a neutrality stance. So upper neutrality limit will be at 24,880, which confluence with the 20-day moving average as well. So neutral between 24,880 and 24,550. So if the US Nasdaq 100 breaks below 24,550, then potentially we may revisit the 200-day moving average at 24,350, and even the next support level at 24,140 next. Right, so that's for the Nasdaq 100. All right, so now let us touch on the commodity prices over here, starting with the gold XAU/USD. So gold XAU/USD continues to hold above the 20-day moving average at 5,095, which was also our short-term pivotal support that we have yesterday. So using 5,095, having a mild bullish bias view on the gold XAU/USD. So breaking above 5,192, where it tries to hit yesterday after the release of the US CPI data, but can't gain any traction, and it traded down lower, but holding above the 5,095 level. So using this level here as my intermediate support level to watch, intermediate resistance level to watch, 5,192. All right, clearing above 5,192 may see a retest on yesterday's Tuesday US session high, which is at 5,238. Okay, so having a mild bullish bias on gold XAU/USD for today, still using the same pivotal support level, 5,095. Two resistance level to watch, 5,192, followed by 5,238 for today. Only a bearish breakdown below 5,095 will invalidate this mild bullish bias view to see a retest on 5,046 range support level that has been in place since 3rd of March. Breaking below 5,046 may kickstart a minor corrective decline scenario to expose 4,960 and even 4,842, which confluence with the 50-day moving average, and 5,842 is the key swing low of 17th of February this year. So that's for gold XAU/USD. Lastly will be the all important West Texas crude oil. So West Texas crude oil, yesterday we do have a bullish bias using 7726/7683 as my short-term pivotal support level. So price action rose, surpassed our mild bullish bias resistance level at 92.47. All right, so this level has really been cleared over here. All right, so with that, I will have now a tightened short-term pivotal support level with this former minor swing high of 11th of March, 7 a.m. Singapore time, and 11th of March, 4 p.m. Singapore time, now turns into a pullback support level at 88.63. Right, so give me a minute. Is it So no, it's 88.36, 88.36. Okay, let me put it back here. $88.36. Okay, let me do the adjustment. 88.36. Okay, so given that it has already broke above that 92.47 level, so it's prudent for us to adjust the short-term pivotal support level higher for a better risk management perspective. Okay, so this one will be a normal support level. Okay, good. So once everything is being adjusted. Okay, so using a tightened short-term pivotal support level for today, 88.36, still maintain a bullish bias on the West Texas oil. Next resistance level will be 100.2.25. 102.25. Okay, 102.25. Above 102.25 will potentially revisit this Monday minor swing high area, 116.56, 119.54. Only a bearish breakdown below 88.36 and an hourly close below it will negate this bullish bias view to revisit 81.85. And this month, this Tuesday US session low at 77.26/76.83 over here. So that's for West Texas oil, still maintaining a bullish bias. However, with a tightened adjusted pivotal support for today at 88.36. First resistance 102.25. All right, so with that, let's sum up the intraday technical outlook on all the broad-based cross asset classes. So other than this ongoing news flow surrounding the US-Iran war, let me share with you what are the key data to take note of for today in terms of the economic calendar on Thursday, 12th of March. So as we head into the European session thereafter, we have Bank of England governor speaking at 5:30 p.m. Singapore time. That could potentially influence the sterling dollar and as well as the sterling crosses over here. And as we go down towards the US session, we have tier 2 US labor market data, which is the weekly initial jobless claim and the weekly continuing jobless claim data over here. So for the continuing jobless claim data, market is expecting almost similar pace of increase of jobless claim for the week ending 28th of February at 1850K claims added. It's almost similar from the previous week of 1868K claims added over here. And as we head into the US session, thereafter at 11 p.m. Singapore time, you have a Federal Reserve official speaking, Fed Bowman. So market participants will be hearing very closely Federal Reserve officials' public speech, given the fact that right now, based on the CME Fed Watch 2, taking into account of the latest price action behavior of the traders in the Fed funds futures market, they have started to reduce the interest rate cuts expectation by the Fed this year from 2 interest rate cuts to only 1 interest rate cut this year. All right. And heading into that, that will pretty much sum up today's economic calendar over here and also sum up today's daily dose of market insights. So with that, do have a prudent session ahead today, given this ongoing volatile movement due to geopolitical related news flow that we can't really forecast much with accuracy, as we got to manage our risk accordingly as this news flow arises. All right, so with that, have a great day ahead and we shall speak again tomorrow. Thank you.